Welcome back to the deep dive. Today, we're jumping into something I think a lot of people in management grapple with. Picture this. A sales manager, let's call her Rose Douglas, spends hours, maybe days, crafting these really detailed performance reports.
Right, crunching all the numbers, trying to figure out what's really going on.
Exactly. And then the president, her boss, basically looks at this stack of paper and asks, is all this analysis, actually worth it? Is the cost of doing it wiping out any profit it might find?
That's the scenario for Rose. Her president, Chernak, essentially implied she's spending too much time staring at spreadsheets, and maybe the cost of that analysis itself is just too high.
It's that classic tension, isn't it? Justifying the intelligence gathering. You collect data because you think it gives you an edge, but if the system gets too cumbersome, too expensive.
The whole effort could backfire. Rose needs to show that her detailed system isn't just looking backward. It's actually critical for planning, for making smart decisions going forward.
Okay, so our mission in this deep dive is to really unpack the framework that helps Rose, and you listening, make that case. We're talking about marketing cost analysis, or MCA.
Yeah, we want to evaluate how effective, how necessary these kinds of complex sales analyses really are. It's about moving from just hoping for good outcomes, being, business profits, to actually delivering business profits.
And showing how you got there, right? Proving what happened and why.
Exactly. So we're digging into sources that lay out MCA, tackle that really thorny issue of cost allocation, and look at the metrics like ROI and Rome that make this stuff actionable.
Great. So let's start with the basics. What exactly is marketing cost analysis?
Okay, so at its core, MCA goes beyond just looking at total sales volume. Sales volume, well, it can be a bit of a vanity metric sometimes.
Sure, looks good on the surface, but doesn't tell the whole story.
Right. MCA digs deeper to figure out the actual profitability of different parts of the business. We call these control units.
And control units could be sales territories, product lines.
Yep. Territories, products, even specific customer groups. Or looking at profitability based on average order size, stuff like that.
Which lets management make much sharper decisions, presumably.
That's the goal. If the analysis shows, say, an entire territory is actually losing money once you factor everything in, maybe you need to redraw the boundaries. Or maybe you change the commission structure to incentivize selling more profitable products.
Okay, I get the potential power. But how is this different from, the regular accounting reports finance sends out? Don't they track costs?
They do, but traditional accounting is fundamentally historical. It records what happened, salaries paid, goods sold, depreciation. It gives you that financial snapshot of the past.
But MCA is forward-looking, a management tool.
Exactly. It's built for planning and control.
Yeah.
MCA really starts where that routine accounting finishes. It needs way more detail.
So standard accounting might just have one line for sales commissions.
Right. But for MCA to work, you need that commission number broken down. How much was for product A versus product B? How much went to customer group X? Which territory generated it? Without that level of classification, well, you can't do the analysis properly.
Okay. Now, most companies are pretty good at production cost accounting, right? Figuring out the cost of making something. Why is MCA seemingly so much harder?
That's a really key distinction. In production, you're mostly focused on the cost per unit of product. And those costs happen in a factory, usually with machines, supervised workers. It's relatively contained.
And predictable, I guess.
More predictable, yeah. There's often a clearer relationship. Cost is a function of volume, C equals FV. If you make 10% more widgets, you have a pretty good idea how your costs will change.
Got it. But marketing costs, they're different.
Very different. First, the units aren't just products. MCA looks at market units too, territories, customer groups, and the costs. They're generated by salespeople out in the field. Less supervision, way less routine activity.
And you mentioned the core question is flipped too.
Right. This is critical. The production manager knows C equals FV. The sales manager needs to know the opposite. What happens to volume if I change my cost? V equals FC.
Like, if I spend an extra $50 on advertising or add 2 reps to a territory, what sales increase can I expect?
Exactly. And figuring that out is much, much harder. It's less precise. There are tons of external factors you can't control. The market, competitors.
Okay, that really highlights why Rose is digging into this. It's not just bean counting, it's trying to model something inherently complex, human behavior, market response.
It absolutely is. And because it's complex, there's generally a structured 3-step way people approach MCA.
All right, let's walk through them. Step 1 sounds like the easiest. Analysis of ledger expenses.
Yeah, that's the simplest, cheapest starting point. You literally just look at the costs as they show up in the general ledger. Total salaries, total rent, total travel expenses.
What's the value there comparing to last year? Or industry benchmarks?
Both. You might see your total sales comp is, say, 4.7% of sales, while the industry average is 6.1%. That tells you something.
But it's very broad. It doesn't tell you where you might be overspending or underspending within the sales function itself.
Precisely. It's too general for real action. Which brings us to the second and really crucial step, the analysis of activity expenses.
Okay, this is where the real work starts.
This is where you take those broad ledger items like office supplies or property taxes, and you regroup them based on the activity or function they support.
So moving from what we bought to what we did, like personal selling as an activity, or warehousing.
Exactly. Personal selling, warehousing and shipping, order processing, advertising. Those kinds of functional buckets.
How do you actually make that shift? How do you assign, say, rent to those different activities?
You need a basis for allocation. Let's use property taxes. Say the annual bill is $120,000. That's your ledger expense. Management then needs to figure out, okay, how much space does each activity use?
Square footage.
Right. If warehousing and shipping takes up 55% of the building's square footage, then you allocate 55% of that $120,000 tax bill, which is $66,000, directly to the warehousing shipping activity cost pool.
Okay, that makes the cost much more meaningful for managing that function. We know the real cost of running the warehouse now.
Correct. And once you've done that functional allocation, you can take the third and arguably most valuable step, analysis by market segments.
This sounds like where Rose's reports really pay off.
Absolutely, because here you take those total activity costs you just figured out, the total cost of personal selling, the total cost of warehousing, and you prorate those costs across the specific market segments you care about.
Like sales territory A versus territory B, or product line C, or maybe large versus small customers.
Exactly. You allocate the activity costs down to those segments. And when that's done, you can create a full profit and loss statement for each segment. And that's actionable insight.
But hang on, that third step sounds like it throws us right into the biggest headache. Allocating costs that aren't easy to assign. The whole direct versus indirect cost problem.
You've hit it. That's the core challenge. First, let's be clear on terms. Direct costs are tied unambiguously to a single segment. If you eliminated that segment, the cost would disappear.
Like the salary of a salesperson who only works in one specific territory, that's direct to the territory analysis.
Correct. But now, change your analysis. What if you're looking at profitability by product?
That same salesperson sells the whole line. Their salary isn't direct to any single product.
Exactly. It becomes an indirect cost in that context. You can't logically split their salary perfectly across product A, B, and C. And honestly, most marketing costs have some indirect element.
And then there are costs that seem impossible to allocate fairly, the big overhead stuff.
Right, what we often call totally indirect costs or just overhead. Think the general sales manager's salary, the cost of the headquarters building, general admin expenses. These costs pretty much stay the same even if you drop a product line or a small territory.
So how do companies deal with allocating these? Because you have to, right, if you want a full P&L.
Well, this is where things get controversial. Our sources point out 3 common methods, but frankly, they all have pretty significant flaws.
Okay, lay them out for us. Method 1.
Just divide the total indirect cost equally among all segments. Simple. Maybe too simple.
Seems unfair. Why should a tiny, struggling territory bear the same overhead burden as a massive, booming one? It doesn't reflect usage or benefit.
Exactly. It feels arbitrary. Method 2 gets, well, ethically interesting. Allocate based on sales volume.
So, the segment with the highest sales gets hit with the biggest chunk of overhead.
Yep. The rationale often given is apply the cost burden where it can best be borne. Successful units should carry more weight.
But doesn't that effectively penalize success? If my team doubles sales, my profit might actually go down because I suddenly get allocated twice the head office rent.
That's the risk. It can be incredibly demotivating. So why do companies do it? Sometimes it's about making all managers feel the weight of the company's total overhead. It pushes accountability down, maybe tries to force everyone to sell even more just to cover their allocated share.
Wow, that's quite a psychological game. Okay, what's the third flawed method?
Allocating overhead in proportion to the segment's direct costs. This kind of assumes there's a tight link between direct spending and indirect support, which often just isn't true.
So because allocation is so messy, especially for those totally indirect costs, we get this fundamental debate.
Exactly. The big controversy, full cost versus contribution margin. And this is absolutely central to Rose Douglas justifying her work. The choice here radically changes how profitable or unprofitable a segment looks.
Okay, define them. Full cost.
Full cost tries to do it all. It allocates every expense, direct and indirect, down to the segment to arrive at a final bottom line net profit or loss for that segment.
Comprehensive, but relies on those potentially iffy indirect allocations.
Right. The contribution margin method, on the other hand, is cleaner, maybe more intellectually honest about the allocation problem. It only allocates the direct expenses, the costs you're certain would disappear if you drop the segment.
So sales minus direct costs equals contribution margin.
Pretty much. That resulting contribution margin number tells you how much that segment is contributing towards covering the total company overhead and generating overall profit.
Okay, this distinction sounds critical. Let's make it concrete. You mentioned the Colorado Ski Company example.
Yes, this really drives it home. The company did a full cost analysis. They allocated everything. And the result? Their Midwestern region showed a net loss of $24,000, negative 0.53% of sales.
A loss. So looking purely at that full cost number, the knee-jerk reaction would be shut it down or drastically cut back.
Exactly. Seems logical based on that one number. But disaster would follow. Because when they looked at the contribution margin for that same Midwestern region,
Let me guess, it wasn't negative.
not even close. It generated a positive contribution margin of $556,000, $500,000.
Wow. Okay. So that $556K is what the Midwest was chipping in to cover all the company-wide overhead, the HQ costs, the CEO's salary, all that stuff.
Precisely. If they axed the Midwest based on that full cost loss, they'd save the region's direct costs, sure. But that $556,000 contribution, gone. It doesn't just disappear from the books.
It has to be absorbed by the other regions. Their profits would plummet because they now have to cover that extra $500,000 in overhead the Midwest used to handle.
Bingo. That is the aha moment. It shows why you really need both perspectives. Full cost is vital for long-range stuff, setting prices, judging overall viability over time.
But contribution margin is essential for those short-run decisions, right? Like, should we keep operating this territory next quarter, and for evaluating the costs a manager can actually control.
Couldn't have said it better. You use contribution to decide if you keep the lights on to that segment, and full cost to see if it's pulling its own weight long term.
Okay, so armed with this kind of analysis, especially the contribution margin view, managers can finally tackle one of the most common problems these studies uncover, the small order problem.
Yes, this is where the 80-20 principle often smacks you in the face. The analysis frequently reveals that a significant chunk of your customers or your orders are actually costing you money to service.
We've got data from the Seal Right Envelope Company that illustrates this perfectly, right?
Oh, it's stark. Their customer profitability analysis showed the biggest customers spending over $200 a year were generating a nice net profit, about 11.9% of sales, using a full cost approach for this example.
But at the other end,
Disaster. The smallest customers, spending under $1,000 a year, showed a net loss of 4.4%. The next group up, also a net loss, 3.6%. All the effort, the sales calls, the order processing, the shipping for these tiny accounts was actively draining profit.
that's incredible. Did they figure out the break-even point? Like how big an order needed to be just to cover costs?
They did. The analysis got granular enough to show that the average order needed to be $440 just to cover the direct selling costs, based on their calculation of $110 per sales call and a 25% gross margin.
So any order smaller than $440, even before factoring in overhead or warehousing, was automatically a money loser from a selling standpoint.
Right, that kind of specific insight is gold. It tells management exactly where the problem lies, and it suggests clear actions.
You don't necessarily have to fire those small customers, though.
No, not always. Maybe you educate them. Encourage them to order once a month instead of 4 times a week, consolidating orders to get over that $440 hurdle.
Or you could set a minimum order size, or add a service charge for small orders.
Exactly. Or, critically, you change how your Salesforce interacts with them. Maybe those expensive personal sales calls get replaced with direct mail or phone calls for the smaller, unprofitable accounts. You redirect your resources.
Makes sense. And if you're making those kinds of changes, you need a way to measure if they're working and evaluate the managers implementing them. Which brings us to ROI.
Return on investment, yes, a classic metric. But the way our sources break it down is really useful. We usually think ROI equal net profit investment,
Okay.
but they split it. ROI, net profit sales, times sales investment. Mathematically, the sales cancels out, so why bother?
Good question. Why the two fractions?
Because they represent two different levers management can pull. The first part, net profit sales. That's your profit margin on sales. That's heavily influenced by marketing pricing, cost control, sales effectiveness.
And the second part, sales investment.
That's your capital turnover rate. How efficiently are you using your assets? This is more influenced by finance and operations.
I see. So the formula highlights that you can boost your overall ROI even if your profit margin is flat, just by turning over your capital faster.
Exactly. Maybe you reduce inventory levels, speed up collecting receivables, close an underused warehouse. All of that reduces the investment denominator in the second fraction, boosting turnover and thus boosting ROI, even if sales and profit margins don't change.
That forces managers to think about asset management, not just sales volume. Brilliant.
And that thinking leads directly to a variation called ROAM, Return on Assets Managed. This is tailored specifically for evaluating people like field sales managers or district managers.
Okay, how does Rome work?
The formula looks like this. Contribution margin district sales volume times district sales volume average accounts receivable plus inventory in that district.
So it uses contribution margin, focusing on controllable profits, and specifically looks at assets like receivables and inventory in that district.
Yes, and that phrase, in that district or managed, is key. ROAM is only really valid if the assets you're including in the denominator of the inventory sitting in their local warehouse, the accounts receivable from their customers, are things that manager actually controls or significantly influences.
Got it. So it focuses the evaluation squarely on the profit contribution they generate relative to the assets they directly manage.
Precisely. It helps delegate true profit responsibility down the line, making managers think about both generating sales efficiently and managing assets wisely.
What a journey. We started with Rose Douglas, feeling pressured about the cost of her detailed reports.
All that paper.
And we end up seeing that this kind of comprehensive profitability analysis, going from ledger to activity to segment, it's not really a cost center, it's an investment, a crucial one.
Absolutely. It's the tool that turns raw data into actual knowledge. It proves its worth by finding the why behind the numbers and showing you what to do next. It directly answers Chernak's challenge to Rose.
It sounds like the analysis pays for itself just by highlighting the disasters to avoid, like dropping that profitable Midwest region or bleeding money on small orders.
Well put. It quantifies the cost of not knowing. It lets Rose show she's creating value, not just overhead.
Okay, before we wrap, here's that final thought for you, our listeners, to chew on. Remember the Colorado Ski Company? Their Midwest region showed a net loss with the full cost method, but contributed over $500,000 according to the contribution margin method.
A huge difference.
So, put yourself in the CEO's chair. Imagine your total company overhead costs, the ones that are hard to allocate, are rising fast. Which method, full cost or contribution margin, might you find yourself pressuring your managers to focus on in their performance reviews, and why?
Thinking about the implications of that choice says a lot about management style and maybe even company culture, something to ponder.
We'll leave you with that question. Thanks for joining us on The Deep Dive.